Today, we are diving into an investment analysis report.
It's titled BMNR Dip, Why This is the Golden Opportunity of 2026.
Right, and the core argument is that Bitminer Immersion Technologies, BMNR, is just massively undervalued.
Trading around $28, but its Ethereum treasury is worth more than its entire market cap.
Exactly. We're talking a $12 billion market cap against, a $13.2 billion asset base, setting up for a big staking catalyst in Q1 2026. Okay, so the first thing that really jumps out to me is the conviction. It's really strong.
Oh, absolutely. That energy is a big part of the report.
And it just goes for it, It calls this the single greatest entry point of 2025, and then later the staking mechanism is a money printer.
And that's exactly where we need to start. Our first point is all about reassessing the tone and rhetoric to align with an investment analysis standard.
So you're saying the conviction is actually a problem here?
Not the conviction itself, but how it's expressed. The weakness is that this highly emotional, sort of promotional language, trade of the decade, money printer, calling a price drop a gift, it actually undermines the professionalism.
Right, it could get dismissed as just hype?
Precisely. You risk alienating the very investors you probably want to attract, the sophisticated or institutional types. They rely on measured analysis.
That's a really interesting point, because you want to grab their attention, but this language might actually be acting like static, drowning out the actual signal.
Exactly. The signal being the PE ratio, the asset disconnect. You've done the hard math, so the suggestion for improvement is to let that math do the heavy lifting.
Okay.
Adopt a more measured, an institutionally aligned lexicon. Trust that the quantitative metrics like a PE of 2.11 on a company holding 4 million ETH are shocking enough on their own.
Let the data be the sensational part. I like that.
Let the data be the star. You can save any stronger language for the final verdict once you've built that solid foundation.
Okay, so give me a few concrete examples. How could we pivot the language right in the text?
Absolutely. So let's take the price drop. Instead of calling it a gift, you could state that the recent price action has created a significant pricing anomaly relative to book value.
Much more objective. You're describing, not emoting.
Exactly. And second, the money printer. Instead of that, maybe describe the Q1 2026 staking activation as the transition to a yield-generating revenue model.
Or the yield-bearing transformation, something like that.
Yes, those phrases are targeted, they feel robust, they align with how this stuff is talked about in finance.
And it's not just the words, it's the structure too.
It is. A simple fix is right in the section headers. The 2026 catalyst, the yield switch. It's a bit catchy, but maybe too much so.
What would you change it to?
Something more formal. The Q1 2026 revenue catalyst. Activation of the Mavan staking network. It's specific, it's professional.
I see. So that kind of shift in language and structure, it immediately elevates the whole analysis.
It ensures the audience gives the compelling math the weight it really deserves, right from page 1.
That makes a lot of sense. That change in tone would definitely prime the reader to absorb the depth here. Now, the report makes a very strong case for the upside. It notes that if ETH gets back to its all-time highs, BMNR's book value just explodes, and it points to analyst targets as high as, $94.50.
The core premise is that narrative shift, right? From crypto winter fears to staking revenue anticipation.
But something feels like it's missing from that picture.
And that brings us perfectly to our second point. Strengthening the analysis by proactively addressing market concerns and counter-arguments.
Ah, the risk section. Or maybe the lack of one.
Exactly! This is where you build maximum credibility. The weakness right now is that the analysis is almost exclusively bullish. There's no dedicated structured section that explores the what-ifs, the limitations, the very real risks.
Well, let me push back on that for a second. Why dedicate a big prominent section to risks? Doesn't that just give a skeptical reader a reason to walk away?
That's the strategic pivot you have to make. You don't address risk to scare people away. You address it to prove you've thought it through.
To gain credibility.
Yes, you show them that even after considering all these potential downsides, the upside thesis still holds. The report correctly identifies BMNR as an Ethereum beta play, but it doesn't really dig into what that means.
The consequences of that sensitivity.
Right. Specifically, the massive downside risk if ETH drops further. I mean, that is the exact factor the market is punishing the stock over right now. And the report kind of glides past it.
So the suggestion isn't just to mention risks in passing. It's to build a whole section around them.
You have to. Dedicate a structural section, call it potential headwinds or sensitivity analysis, that proactively examines everything: execution risks, market risks, regulatory unknowns.
And it shows intellectual rigor.
It shows you've done the work.
Okay, that's clear. So given the focus on the ETH treasury and the future yield, what are the highest priority risks that need to be in that section?
Number one is the asset volatility. It's the elephant in the room. With 4 million ETH, that sensitivity is just immense.
So you need to quantify it.
You absolutely must. A concrete example: include a scenario analysis. Show what happens to the valuation of that $13.2 billion treasury if ETH drops by another 20 or 30%.
And what that does to the market cap discount.
Yes. Show the reader the exact point where this whole net asset value anomaly disappears. That's the line in the sand.
Okay, that's a necessary metric. What about the execution side of things? The MAV on launch.
That's the other big one. You have to address the execution risk of that launch. Ask the hard questions. Does that 3 to 4% conservative yield projection already factor in things like network fees, potential slashing events?
The actual costs of running the validator network?
The net yield is what matters, not the gross yield. And finally, you have to look at the market mechanics. Briefly examine why Wall Street might be punishing the stock.
Beyond just crypto volatility.
Exactly. Is it a liquidity concern? I mean, trying to sell 4 million ETH is not trivial. Could there be future dilution events? Are the operational costs of the non-treasury business too high?
Addressing those things head-on would really strengthen the core argument by dealing with the most common doubts.
It shows true intellectual honesty.
Okay, let's move on to the centerpiece, the part of this analysis that is, it's just the absolute gold standard of the piece.
The valuation disconnect.
Yes. The math is just so stark. Market cap, $12 billion. Total treasury value, around $13.2 billion. And that line in the report, you are buying $1.10 worth of assets for $1, it's so powerful.
It is. And this leads us directly to our third critique: enhancing the clarity of the core valuation anomaly by structurally isolating the net asset value calculation.
Wait, how is the strongest part a weakness? I don't follow.
The presentation of it is the weakness. That incredible fact, the core NAV calculation, it's currently presented as just a brief observation in a section called the math.
Right, and then it pivots to the Amavan catalyst.
It pivots way too quickly. It undercuts the urgency of the value proposition that exists right now, today.
Let me just expand on that, because this is the most shocking part. If the treasury alone is worth $13.2 billion and the market cap is $12 billion, that means the market is pricing the entire operating business.
The technology, the engineers, the future staking model.
At a substantial negative value.
At a negative value.
Yes.
And that unbelievable fact needs to be the anchor of the entire report.
So how do we do that?
The suggestion for improvement is to restructure the analysis. Make that deep discount the structural centerpiece of the valuation argument. It should come immediately after you establish the size of the ETH holding. You have to hook the reader with that immediate value before you even mention the 2026 catalyst.
That makes perfect sense. Present the current shocking reality first, and then introduce the future catalyst that could fix this mispricing.
Exactly.
So what are the concrete structural changes we need to make to achieve that?
First, create a dedicated, prominent section. Title it something like The Implied Discount, Valuing the Operating Business.
And put that right after you confirm the treasury size?
Right after the whale in the room, maybe. And in this new section, you formally calculate the discount. Stated in percentage terms, it's about 9.1% based on these numbers.
And then you drive the implication home.
You have to. You explicitly define what the current market cap is pricing that operating business at. Show the calculation. Prove that the market is valuing it at a substantial negative number, which is just highly abnormal for a profitable company.
That's the moment the reader stops skimming.
That's the moment they start reading very, very seriously. And this section is also how you tie it all together.
Linking the valuation to the PE ratio.
Correct. You use this robust NAV calculation to link directly to that PE of 2.11. You explain that the market's failure to recognize the book value because of these short-term crypto winter fears is the primary force driving this extreme valuation metric. Make that causal link crystal clear.